regardless of your background, I think there's no single person that would have covered all the different elements of that role in any case historically. So you're looking for someone not necessarily with deep. I mean, obviously you need a sufficient level of background, technical and quantitative and financial knowledge. Otherwise, you can't do the role at all. But beyond that, you wouldn't be necessarily looking for someone who's done everything that your role would throw at you from day one, because I think that person just doesn't exist in this day and age.
Welcome to CFO Talks by Aspire, a podcast where we showcase leaders who are bringing finance back to the driving seat of their company's growth in Southeast Asia and beyond. I'm your host, Joel, and welcome to CFO Talks. Today, I'm here with Dom, CFO of Endowus. So I'm really excited because Dom has a bit of an unusual background, particularly as a CFO. He's had a couple of big strategy names like McKinsey and also spent a lot of time with Stanchart. Maybe Dom, if you want to give us a bit of an intro about yourself.
Yeah, sure. So like Joel said, so basically my career is mainly, actually for a CFO, a little bit unusual. Maybe I'll start off with that. This is actually my first CFO role. But the interesting thing about it is I feel like every piece of my, past background has come together to help me actually execute this role. So I started off, as Joel said, advising banks and financial institutions in Sydney, Australia, at McKinsey. Did that for a few years before getting married, moving back to Singapore, and then joining Standard Chartered for 10 years, Singapore and Hong Kong, a variety of different roles, both in strategy, but later on in the business as well. I also had a role where I was creating quant underlyings for the bank to create products to sell to the bank's clients. Then I had a 3-year stint. Immediately prior to joining Endowus, I had a 3-year stint with a boutique quantitative asset management startup called Rayliant Global Advisors. I was their institutional business development head for that. Later on, I joined Endowus about 2 years ago as CFO and head of strategic partnerships, and that's where I am now.
I think before the show, we were also talking a little bit about this being your first CFO gig, and you also knowing a couple of folks who have maybe taken a bit of this unconventional journey.
Yeah.
What sort of made you cross that bridge, right, from maybe the business side to the CFO side of things?
Well, I think, to be quite frank, it's largely because the opportunity came up and I thought it was an exciting opportunity to join Endowus. Really, that was the main reason for it. I think when you join a startup, you invariably wear different roles, different hats anyway. I mean, if I start a little bit on my Endowus journey, I actually started as a client about 3 years ago. During COVID, a lot of people, find more time, figure out your finances, and I have been in banking and asset management for about, over 10 years, close to 13 years, and realized it was not easy to invest. So when I found time to review and all that, I decided that I found out about what Endowus did and I became a client. Actually, that was actually how things happened. Not knowing anyone at Endowus at that point in time. So what eventually happened was, I got introduced to the founders, particularly Sam. And my first few meetings, it was just nothing to do with me as a client. It was just me telling him what a fantastic platform it was. And as they evolved to, we did our first fundraise late 2020, early 2021. And when that happened, I also reached out to say, hey, you know what? I really want to join an exciting platform, exciting business like you. I love your business model. I think you've got things right. What roles, what do you have available, in the sense that, growing company, there's always going to be gaps and so on. So I just wanted to find out more. And the gap just happened to be a CFO role, and they also needed someone to help out with partnerships, and eventually I'm also handling business development. So it's a few different things, but that's how it started. And the way they had described the role, or how I envisioned the role and the person coming to help, it was something that was really, really exciting and appealing for me at the time. And so I took the plunge. That's really how it happened. It wasn't not your standard story where, headhunter reaches out and says, hey, you look like you've got the right background for this, but it's something that evolved over many conversations over a period of time. Yeah, and also myself having to eventually getting comfortable with the fact that I could execute and add value in this role.
Wow, there's a lot of things that I'm excited to touch about there. I heard something about fundraising. I'm also keen to know a little bit more about, how your unconventional background has actually perhaps helped you shape this role, right? Which seems very unique. So if I understand it correctly, you're wearing actually two hats within Endowus, right? You do the CFO side of things. You also run the corporate BD side of things. Do you think that your experience in, sort of having done lots of strategy work, BD work, has actually influenced the way that you have approached running the company from a finance perspective?
Yeah, I think your past experiences obviously shape kind of how your perspective on things, right? I think in my particular role, maybe I can start by describing a little bit. So as you mentioned, there are two main parts. There's a finance piece, which covers everything from, kind of the bigger picture stuff, dealing with investors, doing forecasts, fundraising. Obviously, these are all parts of it, right? All the way down to just making sure the finance ops works, everything from regulatory reporting. We're obviously a regulated entity. There's regular reporting in Singapore, Hong Kong, both markets that we are in, down to, even as simple as making sure that there's enough capital or enough cash so that employees get paid on time. I mean, it's basically quite a wide range on the finance side. And then on the, I guess I can broadly call it the business side of things. It ranges from everything from corporate. I mean, I basically cover the corporate segment. So anything from doing financial literacy programs, which is one of the core things that we do, which I think really sets us apart. We start with education as being one of the key pieces of wealth management, right? All the way through to partnerships, whether it's partnerships with, companies like yourself, Aspire, we've done some stuff together, down to more strategic partnerships where we're even talking about JVs and things like that. I think there is overlap in many, many areas, right? So I can touch on that. So things like JVs, there's obviously an overlap with the CFO role where you're talking about projections, you're talking about strategy in any case. So that's quite a natural fit. And a lot of these conversations are anyway brought to us by investors or by people that want to invest in us as part of some kind of a partnership. There's a continuum, but I think there is some overlap in a lot of this stuff. And then coming back to kind of how my background shapes this, I think strategy is, for me, given kind of my experience and where I've come from, that's always a big piece of it. So always asking, I always say that the one thing I learned from my consulting days is always asking, what's the so what, right? So what about this? So what about that? What's this data? What does that show us? So I think that's helpful. But yeah, I mean, even the fact that, I mean, this is a funny story. So I spent 3 years designing quantitative investment products. So I had to pick up things like option pricing and other things like quantitative investment and all that kind of stuff. And yesterday, I had to sit down and do basically option pricing because we're currently in a fundraising round, as you kind of alluded to, Joel, and we decided to go this round in a convertible note. And so when you book it in our books and records, you have to book the convertible note, of course, mostly as debt because that's what it is. It's a debt instrument. But because it's convertible, there's also an equity option element of it, an embedded derivative, if you will. And our auditors ask us to basically do a valuation of that embedded derivative. So I have to go and figure out how to do that. And I eventually modeled it as a strip of 3 options. I had to figure out the payoff, back to basics, payoff diagram, 3 options, 2 long, 1 short, and then apply input parameters through a Black-Scholes model to come up with a number. So we were able to do that. And then after the end state of that is to pass that number down to my financial controller to say, hey, these are of the amount we raised, this amount is debt, this amount is a derivative. So that was really quite interesting and also quite fulfilling because I realized that probably not many CFOs can do that. It's really a result of my having taken a detour as an equity structurer that allowed me to do that. Not that it's a big piece of my role or anything. I guess I would only have to do this perhaps once a year end, where the auditors ask, what is the valuation of the embedded derivative of your convertible note? And I think most CFOs will go, what do you mean, right? And probably get some external advice to do that, which is perfectly fine. But in this case, I just decided to do it first. We may still get someone external to value it if it's a large enough or material enough number. And actually, I think it's something that you'll find more and more with the CFO role. I think something we'll discuss later on, but it's such a broad role that regardless of your background, I think there's no single person that would have covered all the different elements of that role in any case historically. So you're looking for someone not necessarily with deep. I mean, obviously you need a sufficient level of background, technical and quantitative and financial knowledge. Otherwise, you can't do the role at all. But beyond that, you wouldn't be necessarily looking for someone who's done everything that your role would throw at you from day one. Because I think that person just doesn't exist in this day and age.
Right. Especially like in an environment of a startup, perhaps, right, where you're doing a lot of things for the first time. There's always sort of that need to figure out something for the first time. Yeah. And actually, when I talk to a lot of CFOs, one of the interesting things that I think about or that I come across is that role of a CFO actually changes depending on what company you're sitting in, right? So one of the things I really wanted to ask you was, what is that role like in Endawas, right? And for listeners out there, Endawas, one of the big personal wealth tech brands in the region, right? I think they're in a couple of markets, Singapore, Hong Kong as well recently. And they basically help you invest, I think, through a really unique way, which Dom can probably share more. It's pretty much taken the wealth tech market by storm. What's the role of a CFO there? Are you managing sort of the investments? Are you managing more of the management account side of the business? What's in that scope for you?
That's a difficult question to answer, and it also just it changes over time and depends a lot on what the founders are looking at. Well, for me, there are a couple of things. All right. So the first is that whenever something needs a model, ultimately that comes to me and kind of my team. So we express everything we need in terms of a financial model, right? Whether it's a budget, the budget is very specific. Budget is this year's forecast, right? Or it's a longer projection where you use that for investors or for others. So I think that's kind of the crux of, because you have a set of numbers, you can do pros and cons, you can do analysis, you can describe things quantitatively. I think that's really the base of it. It's a form of problem solving, but with not to say that, obviously in the start everyone does problem solving, but I think when it comes to numbers, that's kind of my domain lah. So that's one area. The role evolves over time. We did an acquisition last year, for example, of a Hong Kong-based external asset manager. So basically an asset manager offline, very different from our model, but slightly different segment. But we feel that that's the way to digitize kind of a higher net worth segment, to acquire and to grow that segment independently on its own and integrate that into Endawas over time. So, I mean, when we did that acquisition, well, I mean, my role also involved trying to look at, what are any red flags, doing due diligence basically, and then thinking through a little bit about the integration aspects of that role, and that integration carries on to this day. It's really quite, I think you hit the nail on the head, Joel. It's really quite broad and really limited only by kind of the number of hours in the day to try to get stuff done.
It's interesting because it sounds also like, you're kind of the person that people go to and consult or ask for a model. And I'm sure your sort of business background also lends to building that, right? The ability to speak to internal stakeholders and so on.
Part of the role really is also to speak to internal, sort of my peers, and also obviously to external stakeholders. That's a big piece of it, and really to support the founders in just whatever shape or form. Where necessary as an advisor or just to execute stuff. Yeah, it's a broad role. It depends on where you can add value at a particular point in time.
Got it. And for you, how do you think about resource management or resource allocation in that sense? What are some of the top things on your mind right now?
Resource allocation. So obviously everyone is very focused on their bottom line and their cost base. So with that, maybe first I want to congratulate Aspire for hitting profitability. That's huge news. I mean, really is huge news in the fintech space.
Thank you.
Yeah, I mean, that's really, really impressive. So in terms of resource allocation, we have to look very closely at where do we expect revenues to grow and really just prioritize that. And obviously growth comes at a cost. For us, it's anything from headcount costs to marketing costs, right? I'm sure you're very familiar with that. You can turn on the taps and get more growth, but what kind of growth is it? Resource allocation in terms of putting bets on where the growth is. I mean, to be very frank, I think the founders take a lead in kind of steering the strategy there. And a lot of us, I myself included, play a supporting role there, but also looking very closely at what's the cost and how does the cost translate to drivers, right? So I think when you describe or articulate financials to an external party, also sometimes internal, but external as well, tend to break things down to key drivers. That's what we have to watch very, very closely. Things like your CAC, for example, or your cost of IT, cost of your systems, articulated as a cost per user, for example, just so that you can really articulate the key drivers of what where your revenues and profitability is going to come from. Particularly for those of us who are still trying to hit break even and then get up that growth curve. I think it's very important because I think in this environment it's vitally important to demonstrate that path to profitability and then to execute against that.
What are some of the unique challenges and opportunities that you've come across so far, right, in your journey, building, a fintech company in Singapore and beyond?
You talking about business opportunities or?
The challenges, right? So has it been difficult to maybe expand, acquire sort of, licenses or, expand to new markets?
Yeah, I think expanding to new markets is it's more challenging than many people realize, ourselves included. So I think as you mentioned earlier, Joel, we just launched in Hong Kong. So that journey started quite a long time ago. Our licenses were initially, I think we got a license at the end of 2021. And I mean, we sometimes joke about this, not too seriously, but we do joke about, oh, it's just cut and paste product. We should just translate over, right? Just localize it. It really ended up being almost like a completely new build to some extent. It took us till from the end of 2021 through till our public launch was actually only in April this year, so 2 months ago. So I think yeah, there are a lot of challenges. I think things will get easier, may get easier. I hope they get easier. Obviously, your first overseas market is your first overseas market. But I mean, even saying that, your home market is also your first market. I think there are challenges every step of the way. Yeah, but as you say, there are also opportunities. Just have to keep your eyes out. I can share a few examples. I mean, as we went along, this is more linked to kind of my role, so I see this more closely. Opportunities do pop up on the corporate side of things. So as you mentioned, we're quite well known as a individual wealth tech platform, retail platform really for individuals to invest and invest their wealth and grow their wealth. What people don't know is that we can also open accounts for non-individuals, whether it's corporates or in some cases charities and others. So we found actually quite a lot of opportunity there as well, because that's also an underserved segment that the banks just aren't good at serving, and we're actually quite capable. Yeah, as we go along, we find all these niche areas and people that love us because our business model is actually very different. We're very, very aligned with the end investor. So in terms of fees and all that, our charging model is completely aligned with the interest of the end investor. And so, yeah, I think that's actually a segment that we've had some recent traction with. Yeah, the opportunities, and if we can expand that in a more scalable way, B2B or others, I think that would be fantastic.
That's interesting. It's like you've taken sort of the underlying tech, right, and you just applied it to different segments or different parts of the market. How much of that fundamental structuring that you talked about, right, that Endowus is really aligned with sort of the customers that they serve? Like how much of that do you think has driven growth in the business?
I think for us, that really is front and center, and it's also what attracted me to the platform to begin with. So, I mean, just to make a quick contrast with those of your more typical bank or platform, if you were to buy a fund or investment product from a bank, first of all, you get hit with a sales charge, but people understand that, so that's kind of fine. We have no sales charge, so right off the bat, that's already a plus. But what's much more insidious than that is that when you buy a fund through a bank or a platform, the fund manager, and takes place all over Asia, Singapore, Hong Kong, and others. The fund manager actually pays the bank. And the way they do that, where does the money come from? It comes from your returns. The way they do that is by charging you a higher fee per annum. I think as you know, when you buy a fund, there's a management fee. But what you may not know is that there are different fee levels, right? So when you buy a fund from a bank, that you get put into what's known as a retail share class, which is a higher cost share class. And then the part that most people don't know about is that the fund manager will pay the bank. Typically, half of that management fee goes to a distribution fee to the bank. We think this completely misaligns interests, because you would then be pushing products, incentivized to push products. I'm not saying everyone does that, but there's an incentive therefore to push products which have a higher distribution fee that the bank can collect versus the products that are the best. And so from the get-go, our business model, actually our innovation is as much the business model that's different as well as the tech to enable that, right? So I feel that it's sometimes the understated piece of it. So our business model is different in the sense that we say, hey, we don't want to collect money this way. We want to use a better method, which is actually what's typically used in countries like the US or Australia, where I charge you a direct fee. Now, we don't like to use that in Asia, or at least the banks. I've been in banking for a long time, right? Banks and others don't like to do this because the perception is that the end investors don't like to see a fee. So they prefer to hide the fee, particularly if it's a completely hidden fee, like a management fee. And then you have a disclosure at the bottom, which is never read by anybody. So from the get-go, we wanted to give best products to you. So we offer what's known as the institutional share class, where the fees could be as little as 1/3 of the retail share class. I mean, it's really that different. We're talking about quite a significant difference, and that's paid over time, right? But instead, we will charge you a clear, clean, transparent fee. And of course, it takes a lot of time and effort to explain what the fee is. And a lot of people, it takes time to explain that it's not, you're actually saving money through this approach, because we then share with you what we feel are the best products for you, not what's the best product for me in terms of my remuneration. And that's important. People don't really understand that, but or don't realize that the impact. But really, I think the incentives drive behavior in this space. And so, just coming back to your question, Joel, so I think it takes time, but once we are able to meet individuals, but certainly also corporates, or in many cases charities, we have a very unique charities offering. We expand on what the standard offering is, but there's a lot of other stuff that we bring to the table. But once we sit down and explain to them our thinking, our philosophy, and our business model, we find that many people are attracted to our way of doing things. And the fund managers in particular love the fact that we're just all about talking about their products, not about how much they'll pay us, because we don't get paid by fund managers. We get paid only by the end investors. And so they've also invited us to come in to speak to the employees, and we have created a product specifically for fund management employees themselves, which probably won't go through here, but I think that's kind of like looking for opportunities, and these are areas of opportunity that come up in the course of doing business for us.
Maybe touching a little bit also on M&A, you mentioned that you guys acquired a company in Hong Kong as well. Is that a big part of your growth strategy?
It's a part of our strategy, because in markets like Hong Kong and also Singapore, I think that segment will take a long time to digitize. So to do it organically could be quite difficult. But at the same time, it's a very significant chunk of the market. And so we also want to bring our philosophy, our fee-only philosophy, and our digitization, right? Just making it cheaper and easier to serve, and bring those benefits to that segment as well. So we feel that will help us to accelerate our growth significantly. So yeah, I mean, actually the Hong Kong acquisition was quite opportunistic. I mean, it's not to say that we didn't have an M&A strategy in place, but I think the way that came out was quite opportunistic. Yeah, but there's also a lot of work, I'm sure, as you know, Joel, with acquisitions as well as due diligence.
Absolutely. And I'm going to sort of shift a little bit. We're talking about sort of managing these client funds and, challenges and opportunities in the market. I'm sure you guys have also been very in tune with sort of the macro developments of late, right? Have you seen any of that impact of the macro environment on how users are taking to you guys, right? For example, you see stuff like SVB falling, users, getting scared about where their funds or how their funds are held. Has that impacted you guys in any way?
Oh, I mean, the SVB issue, actually, I think has been a surprisingly a net positive for us. I've actually been able to acquire some corporate clients who were previously with Credit Suisse, for example, which I think quite surprising for us, in the sense that we're actually a very small, young platform. We're actually able to, but obviously because of the challenges that Credit Suisse are facing, able to win some business over. I think the bigger challenge for us, as well as, and it's not unique to us, it's really a wealth management challenge, was, ever since markets tanked last year, the interest in investing in general, this is not digital investing, this is general wealth management and investing, has really just fallen significantly. So although, I mean, we were able to still grow through that, but what was previously a bit of a tailwind in 2021 became a bit of a headwind. So it's more difficult to acquire new clients. Clients that we acquire take longer to invest. They invest smaller amounts to start, and perhaps take longer to do a recurring investment and all that. So that whole cycle has kind of just expanded. We think it'll come back, and so we'll just keep doing what we're doing. I think markets will normalize. Markets are starting to normalize, to be quite frank, right?
Yeah.
So that's that. But I think the whole SVB thing, I think we're quite fortunate in that a couple of things that worked in our favor. So I think the first is that we actually don't touch clients' money. In Singapore at least, we are just a financial advisor, and the custodian of your assets is actually UOB Kay Hian, which is a very well-known name. So your assets are held there. And the second is that we're through this partnership, we're also able to offer CPF. So I think a lot of people, I mean, the first digital advisor, were the only ones of any size really digital advisor to offer CPF, and we have quite a unique offering there. And I think people just think about CPF, and that's a huge trust builder for us. They think that, well, if Endowus can offer CPF, then, well, I think we can trust them with our money, whether it's personal money or company money. Of course, we believe there's some truth in that, but what I'm saying is that the perception also helps.
Oh, yeah, absolutely. I see the brand.
You see that? So yeah, so SVB, I think, funny enough, it can also be an opportunity.
Yeah, no, I think I've definitely seen sort of this trend even on our side, right? Where, clients, if the company has sort of practiced strong corporate governance to begin with, partnered with the right sort of tier one banks, that actually lends credence and lends weight to their offering.
Yes.
And so I think it was, definitely to your benefit that you guys had set that up early with strong sort of financial partners, and even sort of that opportunity to tap into CPF as a source of funds. That's definitely, for me, when I first saw that, I thought that was really innovative actually.
But it took a lot of effort and a lot of time, and so you can always go back and debate. Oh, should we have done that, or should we have just launched first in parallel? I think it's a case study for future generations, I guess. But we took the bet that CPF was important, and we took 2 years to get that right before we actually launched. But many of our peers' digital platforms have launched without CPF. So yeah, it's a trade-off.
Yeah, my 2 cents at the time is also like, there were players in the space, right?
Yes.
And it gave you guys differentiation. It brought you guys trust. Probably well placed bet, in my opinion.
Let's see. I hope you're right. I hope you're right.
In light of today's macro climate, right? As you were talking about, you were in the midst of a fundraising round right now. How has the macro climate affected that fundraising round?
It's made fundraising actually very, very challenging. I think not everyone can raise $100 million rounds anymore, Joel. Or at least not as easily as we could as in the past. As I mentioned, I joined Endowus 2021. Actually, I joined right after Series A, and we actually managed to close a second round. Unfortunately, we did that. We closed the second round at the end of 2021 as well. So I can contrast 2021. We did a convertible note then as well in November, and we're actually in the midst of closing our another round now. Closed most of it already, but there's a little bit more to go, and probably close it by end of the month. It's a huge contrast. Could not be more different. In 2021, and I'm sure you guys felt the same probably, people were practically throwing money at you. They were knocking on doors. We were being cold called left, right, and center. People who read about our Series A would go, oh, we missed it. We want to find out more. And actually, that's in a way how our 2021, a later round, the convertible note came about, because it was through reverse inquiry, and we thought it made a lot of sense. And thankfully, we raised that money as well, because it helped us to tide over. But yeah, I think since interest rates went up and funding basically funding became more difficult, something that's going to separate really going to separate the winners from the losers. Yeah, because back in the day, I think anyone could raise, almost anyone could raise.
Maybe even start by taking us through a little bit of on that journey, right? Like, I think we were talking a little bit even before this about, it sounded like you had a process, right? That you put in place, and especially when times get challenging, I think sometimes it's important to have that process. But if you could take us through sort of that journey, how you started approaching this round in particular, maybe that could be a good start.
Yeah, sure. So what we wanted to do was to bring in a new investor, because like I mentioned, we did a convertible round in 2021, and then what happened there was we were obviously expecting to do an equity round, a Series B for us in this case. So we spoke to people that we've been engaged with already. And of course, by then the market had already quite changed significantly. We started conversations in the second half of last year, 2022, and they were just taking much longer, and you could feel that the investors were much more hesitant. The bar had raised significantly. I think there's obviously challenges for the VCs themselves or PE firms themselves to deploy that capital. I think their own internal bar has also raised. When you bring something to IC, has to be a slam dunk. Yeah, we hear of deals that get turned down at IC a lot more than previously. So what eventually evolved was we went back, and I think the process evolved for us as well. So eventually we went back to our current investors, existing investors, and we put together something from starting with that. Because what we realized, what we understand, and this is, I think, the right strategy, was that we realized that by having, first of all, starting around with your existing investors and then others following on. So having the existing investors lead is actually the right way to do this because it sends a very strong signal that yeah, we continue to believe in the growth of the story. The people who understand us the best and have known us the longest continue to bet on the company and their growth plans because we're executing. That's the story and the narrative that that sense, right? Of course, they also have they're already invested, so they have a bit of a investor. It's a bit easier, so to speak, as well, right?
Yeah.
But nonetheless, getting IC approval and going through that process still sends a very strong signal because it's also
Yes,
harder
it's
for them.
definitely a good starting platform.
So yeah, I think finally when we did that and our lead investor gave us a term sheet and we got through that process, it was still a hard slog, to be very frank with you. Given that we had gone through with these investors once or twice in 2021, I was surprised at how difficult it was for the third time. And yeah, but it's something. It's just a function of the market, I suppose. Everyone's just being extra cautious. But I think partly because it was so people understand that the bar has gone up so much that when we cross that, that really sends a strong signal as well. And then we've had, obviously, since then, new investors then come on with this, and then we have a few others that are still in the work that we expect to close hopefully quite soon. And that's fantastic because it will set us up for our growth trajectory for the next, 2, 3, 4 years, I think.
For the founders or CFOs that are listening, right? Like I'm sure, quite a few of them have also been through, similar journeys, not found it easy, probably will find it even harder in this climate. At what point should they take a signal from the market, right? At what point do you say like, oh, let's keep trying, let's talk to the next one? Or at what point do you say like, oh, it's not working? Did you have any way to think about that?
We talked about this. I think you had to kiss like a thousand frogs to find your princess, right? I think you just keep talking to investors. I think that's the way to keep going because at the end of the day, you just need one. And so who knows? Maybe the introduction and when your people will always introduce new prospects to you. Yeah, I think unless there's a strong reason not to do it, you just keep meeting. Because even if not for this round, it could be for the next round. It could be a partnership. That could be something else some other angle, right? So you just keep meeting people. I don't know if you have a choice because no, I mean, I mean, obviously you want to meet new investors, but if you are not successful, I mean, there's no plan, there's no option of. I don't know what the other option is, right?
Yeah, no, I hear you.
Yeah, unless you're in an enviable position where you have the ability to turn off some taps and perhaps become profitable. I think many fintechs in general are still along. Some depends on the stage of evolution. Many are still a long way away, and growth is the only way out. So yeah, it really depends. So at some point, you go back to your existing investors and see if they can help you to get through to the next stage. I think this funding environment will improve. Rates will not stay where they are forever. The macro environment will become easier. I mean, maybe not back to kind of earlier stage, but it will not be as difficult as it was last year, I think. And so if you can weather the storm, yeah, those that survive will be in a much better position.
And if you take the macro environment out of it, do you think it gets easier to raise as the rounds go along?
I think the milestones that you need to hit become more and more challenging, right? and why is that? It's because in your earlier round you say, well, okay, we'll take this money, this is a use of funds. I'm going to expand this market. I'm going to target a segment. I'm going to go to whatever B2B, and these are my milestones I'll hit. You make those as promises, and so the next round they're going to look back and say, hey, how much of that have you actually been able to execute? I think obviously if you're able to keep hitting your targets and so on, it will become easier for you. But yeah, I think later rounds bring their own challenges. I think different sets of investors as you go further down, they become more sophisticated. They also they do deeper due diligence. It's kind of the way to explain it.
And if you were to do back of the napkin math, how many investors would you tell, a listener, right? Like they should, is it 50? Is it 100?
What that they should speak to?
Yeah.
I don't know. I'd say it's I think you should speak to everyone that is potentially interested in your segment, your industry. And that's often I mean, if you're based in Singapore, headquartered in Singapore, often in the 50 to 100 range, right? I think we've probably spoken to more than 50. I know CFOs at other firms. Some of them are kind of later stage than us who come up with a shortlist. And one guy I spoke with recently said, "Oh, I've covered my shortlist, and it's 80 people, 80 investors. It's the kind of number." I think we're fortunate too
Yeah.
that there are quite a number of VCs that based here, even if they're overseas VCs, that they have people here. And so it's not that difficult to meet. But of course, nowadays you have Zoom and others as well for the first meeting. But I mean, it's a tiring process. It's like going on first dates, right?
Yeah, no, I mean, big congrats and hats off to you guys, right? Definitely raising in this environment is no easy feat.
We're not done yet, but I'm glad we're about three quarters of the way, I think.
Have you seen sort of the role of CFOs evolve over time? How would you envision sort of the modern CFO or where that CFO function is moving towards in the
Yeah,
future?
sure. So I see my role. I see my role as a bit of being a problem solver, obviously in a specific domain and with a specific set of, well, like I mentioned earlier, I think modeling and coming out with the quantitative aspect of things is something that's expected. But at the end of the day, you're a problem solver. As I also mentioned earlier, right? It's not the role has evolved to an extent that it's very unlikely that one person would have seen the whole range of things that have come up in that particular role before joining. So you're not hiring necessarily for experience anymore. You're hiring for ability to problem solve and to evolve and adapt and to move things forward, right? I think more and more I think the role is evolving to one where the CFO has to be quite adaptable and hopefully having a broad range of experience to help with that area. Because what's going to happen is that you can always get experts to come and help you along your journey, right? I mean, you also have to be quite smart as to when you engage those experts because oftentimes it comes with a price tag attached to it, right? So you can't say, oh, great, new problem, I'm going to do this or do that, get hire the some external advice all the time. There are things you have to do yourself, but I think being able to problem solve, I think, is really the key. And then when something technical, or when you realize that it makes sense for someone external to come in to help you, I think that's always available as an option. That to me is kind of how the CFO role has evolved. And sometimes people ask me, yeah, but you're not Dom, you're not an accountant. So I know enough accounting to be dangerous, so to speak. But I think this big topic of 2023 as well about ChatGPT and all that, you can find out a lot. You can actually train yourself up on a lot of these technical topics such that you understand the implications a lot better than even if you were to go to an external person who's done something for a long time. Pros and cons of either you're doing acquisition, you have goodwill and intangible asset. What's the pros and cons of having these two things, one versus the other? In many cases, you can get that information for yourself, even if you have not done it before. Technology can help you get answers to yourself now versus having to go to an external party to help you with every step of the way. Of course, at the end of the day, you might still end up with, you might still need a valuation report or something along those lines, but I'm just saying that nowadays there are many, many tools there that can mitigate the fact that you've not worked as an accountant for many years, which I think was the earlier perception of what a CFO should look like. And so that role has also evolved from something that's a lot more technical and accounting based to something that's a lot broader and problem solving based. If you're fortunate enough anyway to have a strong financial controller, I think that's still very key. So that person will handle all the like most of the kind of the basic accounting stuff and allow you to add value in more different ways, like strategy and other areas as well.
Nice. No, I really like that view. And what are some of the trends that you've got your eye on? You spoke a little bit about AI.
So I think AI is a very big trend, right? It's a very big topic and one that's very, very interesting. But I think a more basic one, which I think a lot of my peers have to grapple with, are things like cloud computing at the moment. So things like, cloud is a huge expense item if you think about it, the traditional sense. How do you make sure you get value out of it? What does it enable? That's a whole topic in itself. I've actually, worked with my VP of engineering. We've given a few webinars on this exact topic and how cloud is something that really enables you to rapidly prototype and iterate. And I think that role, coming back to your earlier question as well, I think working very closely with your counterparts in the organization outside to understand things a lot more deeply than maybe people in the past have had to understand it and then to iterate through. So for example, we talked about things like classic 1 year budgeting cycle being something that's dead. You kind of have to do it much more iteratively. So those are some of the trends that I see. So new technology, working more closely your technology counterparts. I mean, this is obviously something very relevant to our space. Then iterating through very rapidly on cost and on budgets, something that's a lot more dynamic rather than static. These are perhaps some of the trends I see in terms of work-related activities.
Nice. And to the aspiring sort of CFOs out there, what advice would you give them?
Be flexible with your career and take opportunities when they come. I think that's and I think even opportunities that don't look like they could directly help you, I think will still strengthen your problem solving skill set. Don't just look at a kind of a traditional path. And I think there are many paths to becoming a CFO if that's what you aspire to be. That would be my advice.
All right. Yeah. With that, Dom, I'd like to thank you for your time, for being on the show. I really enjoyed our conversation. Right. Big congrats to you and the team also for being at that final last mile of fundraising. No mean feat in this environment. And I really appreciated the way you shared about your view of the modern CFO and how you embodied that. Someone who is a problem solver, right? In this day and age, as a CFO, like you've mentioned, things change and move so quickly that you don't always come across a problem that you've already solved before, right? So it's extremely important to know to have that problem solving hat as you deal with problems for the first time. And also the fact that being a CFO today is a much broader role, right? It goes beyond the basics, which is still very important, right? Having the right financial controls, like you said, but also the ability to align or find alignment with both peers internally and stakeholders externally to add business value, right? Which your background has really sort of put you in a unique position to be able to do. So thanks again, and it's been wonderful having you on the show.
It's been a pleasure. I hope we have the chance to do this again. And I'm sure we'll be seeing a lot more of each other.
Once again, thanks for joining us on Aspire CFO Talks. If you've enjoyed this episode, please subscribe to the show and follow us and our guests on LinkedIn. That's it for this episode, and we'll see you on the next CFO Talks.